Hello, this is Mike Swanson, and I run the website WallStreetWindow.com, and I got a very special guest with me today. I'm speaking with Iossif, who runs the website MarketViews.tv. How you doing today, Ike?
I'm doing good, Mike. Thank you. How about yourself?
Oh, I'm doing great. Thanks for taking the time to give us an update on what you're seeing in the markets, because we last did an interview several weeks ago about your money flow indicators, and at the time they were really starting to falter when it came to S&P 500, and I was making note that the internals were also it appeared to have peaked out in June, but the market averages have made a new high just yesterday and today, actually. So what do you think is going on?
Well, if you remember, back then I had said that if inflows turn positive and the S&P can put the bottom around 4,300, then by mid to late October, we would be looking at new highs. And surprise, surprise, the inflows did turn positive. The S&P bottomed around 4279, I believe, and by mid to late October, we're making new highs. And if you look at the chart, this actually is a recurring thing. I had commented to you before how over the last couple of years, we have seen something that does not happen very often, and that is cash flows have turned negative only for 2 or 3 weeks, which is very rare. Even within a bullish cycle, you have periods during which flows turn negative. That hasn't happened this time around, or it has just for a few days. And there's a good reason for it. If you look at the next chart, what do we see? We can see that, the flows into global equity funds, and that is a rolling 51-week period, we're over $1 trillion. So when you get that kind of inflows, how can you get any sort of a meaningful negative reaction? You don't. There are 2 points I would like to make is that given that inflows have turned positive and the upside potential that we have right now is at least up to 4,700 and 4,750 the S&P. The second point is that looking at the chart in its entirety, the fact that we have cash flows positive for most of the time, that in itself gives us another signal. And that is what I would like to concentrate on. If you're looking for a sign that the market is weakening, then we should be looking for this indicator to return to its usual or normal, I would say, behavior, which means we see periods of cash flows that last anywhere between 4 to 6 to 8 weeks. That will be a good indication that things are returning back to normal. The excess liquidity is indeed being drained from the system. Right now, this chart, this picture tells me that excess liquidity is plenty in the market. And the $15 billion a month tapering that the Fed just announced, it makes no difference. It's just a drop in the bucket. It will take at least 4 to 6 months to see it making a difference.
Well, one thing about with the Federal Reserve policy right now, the inflation rate is higher. The last report is like a little over 5% annualized CPI that came out in September. And, obviously rates are much lower than that. The GDP growth is much lower than that. And they're not saying they're going to raise rates in any big way for quite some time, if ever. And the Fed Fund futures have like a 50% chance of a rate hike next year in June, 75% in July. which would be at the end of this taper schedule they got. So it's so far off, it seems, that there'd be any sort of restrictive monetary policy at this point.
Well, the Fed has doubled down on its transitory view of the inflation. And unless they get hit in the face, they get punched in the face with high inflation over the next few months, they will continue to support their position.
So you would, I guess you think then that the way the market is now, is that going to be a huge correction, or at least there's not a sign of one for?
Look, the best chance.
Months out.
Look, the best chance for a meaningful correction, was a couple of months ago, and it didn't last very long. What could bring a bigger correction right now would be something exogenous that catches the market by surprise. What that could be, it could be several things. I can tell you one. The bond market breaks down. Okay? A breakdown in the bond market could cause a sharp pullback in the equity markets. But no matter how sharp it is, I don't think it will mean the end of the bull market, because liquidity still remains excessive. That's all I'm saying.
I see. Okay.
Okay. We need to see signs that liquidity is being withdrawn. And at the current rate, it will take anywhere between 4 to 5 months to see a difference. Could something happen to change things before that? Yeah, of course, anything can happen. Okay, but all I'm saying is, if you look at the big picture, liquidity remains plenty. So it's hard for me to see the end coming next week or next month with that kind of liquidity still in the system. That's what I'm saying.
Okay. Well, I feel like everyone's got different ways they're trading and doing this and that, but I don't feel like I got much to do but just wait around and see what happens myself.
Well, what else can you do other than hold on to your positions?
That's what I mean. Yeah, that's what I'm doing. So, but that's why looking at these indicators is so key, because when they do make a big change, then it's time to do something to make some changes yourself too.
And, a good indication that the character of the market has changed is if we see cash flows not only turn negative, but stay negative for several weeks, not just 2 or 3 weeks. Since March of 2020, flows have gone negative only for 2 weeks. At the longest period, that was back in March of 2020. During this past correction, they were negative for about 2.5 weeks. The correction lasted 4 weeks altogether.
Right. Yeah. And we came back down to the 200-day moving average basically on S&P and rallied after that.
No, exactly. And as I said, when you have $1 trillion in inflows over a 51-week period, that is what you get.
Yeah. Yeah. Well, do you got any other thoughts about the market now?
No, that's about it.
Okay. Well, again, this is fascinating to look at, and thank you taking the time to show me and everyone else. And if people want more information, they should go to your website, marketviews.tv. What can they get if they do go there?
Well, my own research, and also the interviews that I do with people like yourself and other colleagues of ours, about 20 that we post once a day.
Yep. And you update this information a lot more frequently too for people.
Yes.
Well, thanks for taking that time to talk to me and everyone else, and follow up again soon.
Thank you, Mike. Good talking to you.